Hi, it's Goernert, Vice President and Senior Investment Advisor of Canaccord Genuity Wealth Management and Goernert Wealth Management, here to make some sense out of your financial world. Now today, I'm lucky enough to be joined by Managing Director of Advisor Services of Canaccord, Kevin Vandermeer, along with Senior Associate Meng Gao, for our Inside the Markets talk. So I'm just going to turn it over and talk a little bit to Kevin. Kevin, how are you today?
Good. How are you?
Very
Thanks
good.
For,
now,
having me back.
Well, I'm so glad. I mean, last time you were on there, we had just a lot of views, and that made me feel really good. And I think we covered off a lot of information. For people who haven't watched this before, if I do some fumbling, it's because Kevin has thoughtfully brought on Meng, and I've got to fumble my way through the technology, but I think I can do it. So, Meng, how are you today, sir?
I'm good, Greg. Great to be here. Thanks for having me.
You're very welcome. By the way, I love the gamer's chair. That is awesome. My son would be so jealous. I'm so jealous. So
that's my edge.
Well, hey, why don't we jump into it? You know, Kevin, talking to you, you and Meng are kind of the go-to guys. Like, obviously, in our business, we read a lot, we do a lot of things, but you throw us a lot of information sometimes on things that we might not otherwise see. But the topic that seems to be coming up right now is the election cycle in the United States right now, and how that affects the markets as a whole. What you sent a great piece about a week ago that perhaps our memory of presidential cycles isn't what it actually is, and how the data backs it up. So, how would you look going forward in the marketplace right now?
Sure. So let me take a stab at it, and then Ming will cover off anything I've missed. So, we're something like 42 days away from the election in the U.S. It's going to be probably one of the most contentious elections that the U.S. has had in quite a while. Right now, Biden, as many of you know, is leading. He's leading in some of the important states, and but Trump is sort of closing that gap. And because of COVID, what the Democrats want to do is have a lot of mail-in votes. So what people don't fully appreciate is that most of the Republican vote will come in on the day in which, on November the 3rd. But a lot of the Democrat votes are going to come in via mail. So what I think is different this time is we're not really going to know who the president of the United States is, maybe for a week or a couple of weeks, especially if it's close, and especially if it's disputed. And Trump, in many ways, has already told people he's going to dispute it, especially if he loses, which means it could go to the Supreme Court, which is why his appointment of a new judge is so contentious, because obviously if he gives somebody the job, and it's one of the most prestigious jobs in law, that person is going to have some kind of bias to, turning a decision to a Democratic vote. So
now that ties right back into a piece that you both sent me, about 2 weeks ago, just on the unprecedented options volatility action that you're seeing out there. Is that still happening right now, where you've seen that just a lot of volatility in is moving, and how that might develop?
Yeah, so I think what people are starting to do, and what the great thing about the options market is, we can have a conversation about what might happen. What the option market allows us to do is see where people are actually placing their bets. And so what's happening inside the option market, we can see where people are placing their bets, and they're expecting a lot of volatility. So volatility means there's going to be movement, either up or down, and that's how people are positioning. So as we go into this election, the thing that the market doesn't like is uncertainty. And what we are certainly going to get is a period of time of uncertainty. And that's why people are sort of protecting themselves, or at least making some bets on volatility and uncertainty in the market. I should bring in Ming. Feel free to jump in here, Ming, if I've missed anything. But that's kind of the setup here as we go, kind of the next month and probably 2 months around uncertainty of of who potentially is going to win. And you can imagine that if the market is uncertain about who's going to win, that impacts fiscal policy, it impacts monetary policy, it impacts international policy. So there's sort of a lot at weigh here, and the market won't have clarity probably for some time. Ming?
Hey, Meng, you want to jump in there?
Yeah, no, I would echo on the back of everything Kevin has already mentioned, but just for some more color, I mean, in the initial when the initial elections started to hit headlines, everybody was trying to think about who would win, and obviously the result and outcome on the markets. I know for myself in the beginning, I was speaking with a lot of advisors, and everybody thought, if Trump somehow loses, it would be catastrophic for the markets. But we took a look at data and history, and actually suggests that a democratic government is actually rather better for the markets in the long run. So that just
that's
shows
interesting.
you.
Yeah, interesting.
Yeah, that's for sure. And then back to the volatility topic, a good measure that we like to use is the VIX Volatility Index. So usually when this index closes above 20, that kind of signals that there's definitely volatility. And as of today, I believe it closed around 29. So that just shows you once again that as we head towards elections, volatility is definitely ramping up.
Interesting. I mean, those are good points. Now, and on top of that as well, seasonally, September is the weakest month of the year, followed by October. But in particular, the third week of September tends to be the weakest. Meng? Third week of September, weakest month? Sorry, weakest week of the month?
Yeah, I'll start and make you jump in. But yeah, we came across some work that another individual did, and it's amazing. This third week in September is consistently, and there were sort of two studies that were done. We did our own on the Canadian market, but another individual did the work on the U.S. market, went back to the 1960s, and assumed that if you started with $1,000 and you invested it at the beginning of the third week of September, and then you stopped investing it, and then you invested it again the next year at the third week, you basically lost about 60% of your value. So what's amazing is that it's the consistency of that third week. And so then we took that same methodology and applied it to Canada to see if that held true, and we had essentially the same result. So on average, this week that we're in right now, and it's almost over, is down about 1%. Now the range around that is pretty high. It's been down as much as 6.5%, and it's been up as much as 5% in Canada, but fairly consistently it's been negative. Now, what we would say as investment professionals is, don't get scared out of the market. Stay in the market, stay invested, and think longer term. But Big, maybe you wanted to add to that.
No, I think a lot of individuals, even like myself, tend to focus on the short term a lot. I mean, whether it's this week or the third week or second week of the market being weak, I think we look at the long run. I mean, one of our very reputable market strategist, Tony Dwyer, he's recently highlighting that the game plan hasn't changed. We're focused on the fact that there's global market recovery. And the Fed has essentially came to the market and said they would stop at nothing to provide market function and liquidity. So all these theses have not changed. And, just because we have one of the worst weeks, which is coming to an end, should not impede the long-term goal.
Yeah, I mean, and that's such a good point too, because the other thing that we're looking at, just bringing up Tony Dwyer there, and I know I had Martin Roberge on the show 2 weeks ago. The unprecedented amount of liquidity in the marketplace right now, and you've even seen the head of the Dallas Fed come right out and say that rates are going to stay low for, I think he said, at least 2.5 years to 3 years. Yeah. And we're once again more unprecedented time where we have central bankers tell us what they're going to do, which was never the case in the past. So, Kevin?
Yeah, no, I was just going to say that another study that we looked at, because the election is so topical, was that if the market weakens from here into the election, it's more likely that Biden will win. But if the markets strengthen, or at least stay positive from here into the election, then it's more likely that that Trump will win. And we don't quite exactly know why that is, but it might be just that if people are feeling good about the market, that the market's working, why change? Why go for a change? But yeah, as Ming highlighted, under a Democratic presidency, historically, the market has performed better. But in terms of a signal to determine who might win, it would be one of the best indicators is whether the market is performing strong. If it does, people are more likely to keep the existing administration in power, which is quite amazing.
Yeah, that's interesting. And, it leads up to another thing, too, what the market is pricing in right now. Another thing that we've been talking about for the past little bit are the possibilities of a vaccine. And is that priced into the marketplace right now, or is there potential upside in anticipation of a vaccine? Who wants to jump on that? Meng?
You start.
Sure, I could go first. I personally, it's hard to say. I would say I'm leaning towards a bit less being priced in, and I'm just looking at pure examples. So today we were just looking at Air Canada. It's a Canadian darling stock. Once one of the biggest major large caps in Canada, but now it's around $5 billion. But I just think that if vaccine price was to be priced in, I think we would see Air Canada, names like this that I would put in the tier D, the last tier of the COVID getting hit stocks, the worst. I would see that stock probably do much better than it is today. So that's my take.
Yeah, interesting.
Yeah.
Kevin, anything you want to throw it on that?
Yeah, I think, look, I think if we step back and we look at what's happening globally, obviously an enormous amount of money and resources is being, put to work to find a vaccine by not only U.S. pharmaceutical companies and biotech companies, but companies in Europe and around the world, including, Russia and China. Everybody's trying to solve for this, right? This is more of a global issue. And some of the work that's been done, some of the best work I've seen is done by UBS. And they said, if a vaccine was to be announced, that it was, approved, that it was, everybody sort of was in agreement that there was a true vaccine that solved the issues that we're dealing with, probably there's 8% upside in the market. If there continues to be delays, and we've sort of seen, Trump said that he thought that there would be a vaccine before the election. Well, that window is quickly closing. And, if we continue to see further delays, probably the downside is maybe 3 or 4%. So that's kind of how some economists and strategists are thinking about it. So, to Ming's point, I think is bang on that, the market really hasn't priced in, and probably rightfully so. We typically, a vaccine would take years to develop and properly validate. And we're trying to do this inside of a year and do it very quickly. I read a headline today that, the U.S. administration could overrule the FDA in terms of its ruling on a vaccine, which is a little bit scary.
A little concerning, yeah.
Yeah. I covered pharmaceutical companies and biotech companies as an analyst early in my career. And the primary mandate of the FDA is really about safety, about not doing harm. And the FDA as a regulatory body to approve the viability of drugs really came out of the 1900s, or early 1900s and the 1930s, where people were legitimately or selling snake oil. And so people didn't know what they were buying or what it was, and people were getting sick. And so the government set up something that said basically, like, you need to be approved, there needs to be a reason for it. But the primary reason for the FDA is around safety. And so if you have a government entity overruling that, that brings into play, some other dynamics that maybe would cause a reason to cause for pause, maybe.
Yeah, that could be some nasty stuff. Just moving across onto the trade front, China trade, and maybe also just to pivot on the Canadian experience here. We talked about the U.S. economy, we talked about the U.S. market moving. First off, just before we jump into trade, why don't we talk a little bit about where you see the Canadian markets going? Do you think that we'll piggyback on the U.S. markets, or do you think we have some different issues here that might provide us some headwinds? I'll turn it over to Kevin, maybe.
Sure, yeah, I can start and Ming can jump in. So, I mean, as we look at Canada, the Canadian market, if you look over the last year, has been one of the weakest markets. So, amazingly, China and the U.S., even though they're in a dispute on trade, have been the two strongest markets. Not surprising, China coming through this pandemic, they were the first to go through it and the first to come out of it. Canada has really lagged, and there's been a couple of reasons for that. One, we have a large allocation to energy in our index, and energy has been the weakest sector. We have the strongest sector has been technology and materials. Materials meaning primarily gold. Problem with our index, not necessarily the problem, but when you look at the composition of our index, we have kind of 5 or 6% allocated to technology. That's very different than the U.S., which has got about a 26 or 27% allocation to technology. So, and the U.S. S&P 500 has a 3% weight in energy, and in Canada, our weighting in energy is closer to 15%. So you can see how the Canadian market is underweight some of the strongest sectors and overweight some of the weakest, which has caused it to lag. Where we go from here, we need, and Meng jump in, but we need energy to work for our overall index to work. So stronger energy, if there was a change in power and sentiment around energy, that would certainly help the sector. The other thing that would be beneficial is if we had some clarity around the economy, and that would help our banks. So right now, the Canadian banks, have lagged the broader market, and if we had clarity on how quickly everybody can get back to work, and specifically kind of Main Street Canada, that would definitely help with loan loss provisions, mainly reducing that, which would help the banks. Ming, did you?
Yeah, Ming, why don't we jump in on this?
Yeah, no, I agree with everything Kevin mentioned. I would just add, being an optimistic Canadian like myself, I read this thing a couple of days ago that said it took basically the TSX a decade to go from 5% allocation tech to 10. So I don't think it's going to take the next decade to get the next double. I think Canadian tech, as you see, there's insane amount of great companies IPOing that, the recent Nuvve, there's Dine & Durham, there's all these great companies. And I think as our index, slowly transforms and morphs into more, like Kevin mentioned, more tech exposure, more of the sectors that are actually working, hopefully Canada starts performing better. But obviously, based on history, it certainly lags the other nations.
Yeah, and that's a good point, because we always have been somewhat a rocks and trees economy, and we like our banks. So we have our banks, we have our insurance companies, and kind of everything else is kind of second best. Okay, so forward in Canada, probably want to see some better energy prices before we start seeing some good movement in our markets. So, but North American markets stepping over to the States going forward, I still think there's a lot of opportunity there going forward, and I really don't think you fight the Fed. And if the Fed is telling us to be in the markets, I think you have to be in the markets. I think you do have to be careful that you're not being, doing the typical Canadian homer, which we are the biggest homers on the planet when it comes as far as investing. We have so much of our assets invested at home, and for the past little while, these have been, areas that have been underperforming. So, I don't think we should be shy to be moving out to high quality companies globally, and in particular in the States. Any thoughts on that?
Yeah, I'll start maybe. For sure, look, the amazing thing about the U.S. is, half of the in the publicly traded wealth, if you will, or market capitalization globally, half of that is traded in the U.S. And we think of a company like Apple, or we think of a company like Microsoft as being an American company, or even J&J, but in many cases, 50% or more of the revenue of these large, mega cap companies come from outside the U.S. And so, as much as Microsoft or Google or Facebook or Amazon are thought of as American companies and trade in the U.S., these truly are global companies with enormous reach. And so when you do buy a company like some of those large mega caps, in many ways you're buying a company that's sort of a proxy for global growth or global opportunity. And so we really don't have companies like that, kind of global champions, if you will, in Canada. Mm-hmm. So somebody who's biased to owning only Canadian companies is missing out on some of these truly great companies. We could look at a company like Shopify that's sort of emerging as a truly global leader, if you will, or global champion. But thinking more about the U.S. and the U.S. has been strong, really strong for 10 years. I don't think anybody in finance would have thought coming out of the credit crisis that the U.S. market would be as strong as it has been. Mm-hmm. That was really ground zero for the credit crisis and all that was. But to see that market perform, we're never sure of what will transpire, but certainly many of the truly great companies, publicly traded companies in the world, are traded in the U.S., and we would encourage investors to have at least some allocation there.
Meng? Now, Meng, maybe final words for you as we wrap it up here. Really appreciate your input. But jump onto that thought of, well, dollars today investing, where would you be looking?
No, I think the one thing I learned working with Kevin is that diversification is very important. Through my very limited time in the markets now, I feel like I've only seen like the U.S. markets working, right? U.S. market, you always buy the dip and it only goes up in a straight line. But apparently, once upon a time, there was 10 years where nobody wanted to buy that U.S.
I've been
market.
there. Definitely been
right?
there.
And it was very hard to believe. So, and we did a study and we looked back over the long term, different asset classes and different areas of the market tend to work in turns. So you might get 7% average returns in Canada, if we put that in the international bucket, and you might get 8% average or a bit higher in US, but that just argues overall for a diversified portfolio.
Hey, well, why don't we leave it there? Thank you very much, Meng, for joining me. Kevin, thanks so much for joining me. Really appreciate you putting your thoughts here together. Guys, have a great day. Thank you very much. Bye.
Bye for now.